It's actually nice to be able to talk for more than 15 seconds yelling at somebody else on TV. I'm actually quite happy that my friend Condo no longer does the sort of like what I call the Brady Bunch setup, where you're 6 people yelling at each other. So it's just going to be me pretty much yelling at myself today, and let's see if I've got the clicker here. But I'm going to talk about the commercial real estate market. See a little bit of a distinction. There's a lot of similarities to some of the things we just talked about. And I'm also going to note, I'm going to give you a lot of slides and a lot of numbers. Some of them I'm going to go through quickly. There will be a PDF presentation up available, and of course you can email me, and I'm happy to send you any of this information. The bottom line, which I'm going to start from the very basic, very general before I get down to some of the individual sectors, is that it appears to me that commercial construction itself has hit bottom. Very slow increase, but we're more likely through the worst of it. A couple of themes I want to leave you with, I'm going to come back to in more detail, is a lot of this is being driven by the office market and the apartment market. The industrial side and the retail side are still quite weak, and we're going to go into a little bit more reasons why we've seen such a distinction there. Now, for me, one of the primary distinctions is that most industrial construction tends to be something that you build for the end user. A lot of the office market, a lot of the apartment market is built on spec. So we've seen some of the speculative demand come back, but some of that in my opinion, is driven by economic fundamentals that sort of come after the demand is not back. And that's a theme I'm going to come back to, but I think it's an important distinction between some of these markets. I'm not going to talk a lot about multifamily because the last panel touched on it, and most of what they said I agree with, but I would say in the same way, and this is what you're seeing is completions, permit starts, and let's keep in mind that obviously the permits and the starts are prior to the completions, and we've started to see the completions, in my opinion, start to take that trend. For a while, starts, permits were starting to edge up, and completions would still start flat. So we're starting to see those earlier permits being pulled. Many of them start to come on the market and give you a little bit more detail. And the important numbers to keep in mind, these are from the census, which is why they're both probably the most accurate, but also the least timely, because January is a bit behind us. And I think you can see from July to January, particularly again on the completion side, and these are in the hundreds of thousands, pretty major jump on the completion side. So you really are starting to see the apartment market start to come online in a way. And certainly you saw some jumps in the starts and the permits, but not to the same degree. So we are starting to see that speculative activity start to hit the marketplace. And whether that starts to bear down on the existing supply of apartments, we will find out. Also, the sales activity is really started, and to give you some sense real quickly, so there's a lot of color here and a lot of numbers. This is apartment, this is retail, industrial, and office. And the things, again, to remember, it is really the apartment and the office that is driving this. The increases in industrial, the sales have still been very slow. Same thing for retail. And again, we're going to come back to a little bit more reasons to give you some thinking about that. A number of different price indices have started to show that much of the decline in commercial property prices has reversed itself. Now, we are still considerably below peak. How far below peak depends on what series you're looking at. It's important to mind, these prices hit bottom essentially in 2009 and have been a slow increase since then. So to some extent, the correction, at least on the price side in commercial real estate, has happened quite faster, in my opinion, than the housing market. I could give you some of my insight, some of my opinions on why that is. For instance, we don't tend to wait 2 to 3 years before we get somebody out of a office building if they're not paying, whereas we do in the housing market. So some of the ability to collect on this. And of course, the other side of it is bank loans are much more willing to be negotiated in a way that you don't see on the residential side as well. So there's a couple of reasons, but the message to take away from this is that the price correction in commercial has largely happened in terms of hitting bottom and seems to be ahead of the residential on that side. Now, vacancy rates to me are also an incredibly important thing to take a look at. And what you're looking at, the top line is office, the middle line is retail, and the bottom line is apartment. And again, the message I would take away is consistent with what I've said before about the retail not really seeing a lot of activity. You've still seen pretty flat vacancy rates in retail. That has not come down. Office had started to come down a little bit. It's really the apartment market where you've started to see some decline in vacancy rates. So let me talk about the retail for a second, why I think we've started to still see retail sluggish And again, I don't want to say that I think office or apartments have been booming, but relative to the retail and industrial side, they have been. The top line, what we're looking at here is retail sales. And often, I think you listen enough in the media and listen to the conversations about the economy, and it sounds like that nobody anywhere is spending anything. And that's actually not true. It's a very basic measure, which is not up here, but consumers today are actually spending in real terms more than they were at the peak of the bubble. So people are going out and spending money. They're just not necessarily spending money on what they were. And so again, the top line is retail sales. The bottom line is retail sales when you pull out autos. And a lot of the increase in retail sales over the last couple of years has been a rebound in the auto industry. And again, obviously, the auto industry is not necessarily going to help Walmart. So again, it's different segments of the retail sales have been leaders here, and again, that makes a very big difference. Another thing to keep in mind, what you're seeing here is the percentage of retail sales that are sold online. I call it e-retail. You can think about whether it's you buying your holiday gifts at Amazon and such, and you've seen a pretty steady increase in this, and I would say over the last 10 years, it's almost tripled. Now, it's still a relatively small amount in the scheme of things, but at the same time, my sense is that's going to continue to be a very long trend. I think it's going to continue in that direction. Now, it means two different things. I think in the long run, it's going to be positive for industrial. Amazon needs warehouses somewhere. Of course, it's not going to be very good for your brick and mortar retailers. So even though, as I mentioned, some of the retail has come back, it hasn't necessarily come back at brick and mortar locations. And I think that we'll continue to see a lot of that migrate online. I'm going to come back and later to talk about some policy issues that may or may not change that trend a little bit, but I don't think it's going to change the direction of the trend, it's the speed of the trend. This is building materials to retail consumers. And to some extent, this is the sort of activity people would do in sort of remodeling their home and such. And so some of this, I think, it has started to come back. One of the drivers of this is, of course, when foreclosed homes start to hit the market again, and after a home has been in foreclosure for a couple of years, it almost always needs a little bit of help. And you're going to start to see more of that as the foreclosure chain, I think, starts to flow through a little bit more. Just for a second, earlier the comments on renters and on the housing boom in Boston, and what you're seeing is the lighter line is change in owner-occupied units, and the darker line is change in renter-occupied units. And certainly over the last several years, we've really seen a very big conversion. As was mentioned in the previous panel, a very large number of these renters are simply moving into single-family homes. So to some extent, this is certainly going to help the apartment market, which is, again, I mentioned earlier, the sales, the activity in the apartment market seems to be driving a lot of the commercial. I think ultimately we're going to see some of this reverse itself. Certainly there's some demographic trends, but to some extent, when occupants are ultimately going to look at what's the cost of renting versus owning. In many markets today, it's simply cheaper to rent. I don't see that necessarily as a sustaining factor, but again, that's going to be a driver of multifamily demand. One of the things you can see, the top line is the amount of new multifamily construction. That's condo. The bottom line is for rental. And so almost all of the increase, again, in multifamily has been on the rental side. It's fair to almost characterize the new condo market as dead. Also keep in mind that the condo market, really, you start to think about the South Floridas, you start to think about the Las Vegases. This is really one segment of the market that was massively overbuilt and a massively overbuilt market. And that's going to continue to be a drag on multifamily. I don't really see the condo market coming back anytime soon. What you're seeing here are the numbers for absorption. The top line is for apartments. The bottom lines are for retail and office. And I think the interesting thing here is that you're certainly seeing as apartments are coming online, they are being absorbed, they are being filled. For the most part, the office and the retail market, whether I want to call this balance or not is an open question, but you're getting to the point where it's really just being taken up to the market. So to me, this also says that the demand is really not strong yet for the office and retail market. You're not seeing even what's brought on the market absorbed in a big way. And so I think you're going to continue to see a drag on that market in that way, where multifamily still continues to drive the commercial side. Same thing on inventory. Now, the positive here is that inventory, pretty much consistent across these asset classes, has been declining. So the positive is we are not building up a very large number of vacant offices and vacant retail. We're working off essentially what we had. And again, once you start to get to a zero, when you start to get to negative, is when you're really going to start to see the market come back. So again, we're headed in the right direction. Qualitatively, things are moving, at least judging by inventory, in the right direction. Rents, same sort of story that reinforces it. Retail rents have continued, and that's the bottom line, have continued to be flat and declining. And again, until we start to see retail sales come back in a much bigger way, I think you're going to continue to see that's the case. The only place you've really seen rents go up is, again, on the multifamily side. The office has been quite weak, not as weak as the retail. But again, these don't pretend to me to be a sign of increased construction or increased sales beyond the modest levels we've seen. Ultimately, almost all of this, certainly in the office side, is about jobs. So I can't over talk about it in jobs, but to give you some sense of what drives a lot of this, about half of the demand for office space from workers is from finance, insurance, and real estate. And so as long as we're in a world where Bank of America plans to lay off tens of thousands of people, this is a world in which office market will remain weak. So again, a lot of this is tracking the finance side. Where I live in Washington, D.C., about a third of the office market is driven by government. Now, that's been very well for D.C. That has not been very well for other markets. So again, until you start to see some of these professional services come back, until you start to see finance come back, until you start to see insurance and real estate come back, the office market is going to be a very big drag. Now, in some ways, these jobs numbers are less important for industrial and other components. A lot of what little strength we've seen in industrial, in my opinion, has been warehousing for manufacturing for exports. And so that's one part of if you want to think of a silver lining in our economy, that the weakness of the dollar has helped the export market, and that has helped a little bit on the industrial side, but not enough to really make a very big difference, in my opinion. It was mentioned earlier, touched on in financing. A lot of the constraint here is financing. It certainly becomes just very difficult. The commercial mortgage-backed securities market is essentially dead. I mean, there's certainly some signs of life, but is nowhere near what it was, and certainly has not been picked up by other segments of the economy. I want to give you at least one other option to say the life insurance industry, for instance, has stepped into some of this gap. But what the life insurance expansion has funded has been about a tenth of what the CMBS market was funding. So again, it's not like that's being met by the life insurers or others. And in fact, the largest source of funding for the commercial mortgage market is simply bank loans. And this is another one of the primary constraints. And of course, the banks tend to be the most dominant side when it comes to short-term finance and the construction financing. And let's keep in mind that these small regional banks have been the very large sources of this and still remain with a lot of trouble. We had over 400 small banks fail over the last several years. This has certainly been a drag on construction lending on the office side and on the retail side. And you just have not had other factors pick that up. I'm going to come back and talk about this a little bit more, but I think we've got some regulatory headwinds that, in my opinion, are going to make banks even less of a player here, even considering that they're the most dominant player right now. But the bottom line, the takeaway is that there's going to continue to be financing difficulties facing the commercial side that's going to put some constraint on construction and sales. I talked a little bit about, I know there's a lot of detailed words on this page, but I just want to highlight a few things. This is what segments of the economy are essentially on the demand side. Who is demanding commercial real estate? The really big numbers are unsurprisingly, and I'll also emphasize, this is from census, which is why it's about a year or more out of date, but it's also the most accurate numbers you're going to find in terms, and I don't think the trends have really changed all that much. But the point, mining is very big. You probably read in the Dakotas, they've gone through a big energy boom. I think a wild card in my mind is what happens when interest rates start to go up. Will we see commodity prices start to go down? What will be the impact on the energy sector? But that's been a big driver on the industrial side. On the other side, in terms of office space, healthcare has really been a big driver here. You'll notice I mentioned earlier that finance has been a relatively small component of this. And again, that's because that industry has not yet come back. Same on the real estate side. But again, some of the factors and some of the components of the economy that have been big drivers of this, durable goods has really been driven again by the export market and have been big demanders here. So again, until at this point, we're going to see healthcare and professional services really be the driver of at least the office market in the interim. I do expect, as we move forward in the next couple of years, the finance sector to start to come back to a degree. But again, a really big concern I have on the industrial side and the manufacturing side is what happens in the energy markets if the prices start to moderate. And again, I'm not going to pretend to have a crystal ball and tell you what the price of oil is going to be in a year, but I will tell you what the price of oil in a year will matter in terms of industrial demand, and it's really a big driver right now. So that's certainly something to keep an eye on. We also are seeing, again, I want to emphasize on the manufacturing side, a lot of this, again, is export-driven because of the weakness of the dollar. The chart you're seeing here is material orders from manufacturers. And this is not just for new construction, but it's also for the rehabilitation of existing facilities. So you've certainly seen an increase, not back to where it was at the peak of the bubble, but again, a movement in the right direction, and again, an indication of the health of manufacturing that's starting to come back in this country in at least a modest way. Let me talk about a couple of policy issues, because I think ultimately the biggest drivers for commercial real estate today going forward are going to be policy decisions. The biggest of all is absolutely what the Federal Reserve does. And certainly we've heard Chairman Bernanke say we're going to keep rates low for a very long time. I will note that he certainly has some control over the rates at which the Federal Reserve controls, but if inflation starts to come around, many of those things can get out of hand and lose control of the Fed, and also to some extent, once inflation does come around, the Fed will start to raise rates. So I think it's probably fair to say that rates are about as low as they're ever going to get, or in that vicinity. Maybe another 10 basis points, but again, it's hard to see funding become more favorable. And of course, what happens when the rates start to go up? Property values start to go down. So I think that that's going to be a headwind that's not only going to get the housing market, but is going to hurt the commercial real estate market as well. Whether quantitative easing, in my opinion, could be a potential benefit for the commercial mortgage-backed securities market. For those of you who have not followed closely what the Fed has done, the quantitative easing has been pretty large-scale purchases by the Fed of residential mortgage-backed securities and treasuries. And of course, the intention here is to push investors into other asset classes. And I do think that this will be a help getting other investors looking at commercial mortgage-backed securities rather than the residential, which the Fed is buying. Now, we really haven't started to see much of that lately, but again, that can have a big impact. Another important thing to keep, as I mentioned earlier, banks are the primary source of funding, particularly on the construction side. And one of the things that banks are looking at today is essentially a flat yield curve is a very difficult environment for banks. You keep in mind that you're borrowing short, you're lending long. And if you're putting yourself in a very difficult position. If I lend at 3 and I borrow at 3, I don't make any money. So again, you might remember the old quip about bankers being you borrow at 3, you lend at 6, and you hit the golf course at 3. That world is not the world that bankers live in today. So again, it's a very difficult environment for this part of it. And of course, there are other things that help banks on the other side of the investment. This is a good environment for investment banks, but it's not a good environment for retail banks. And again, whether we see a change in the yield curve is really going to have a big impact on that. One of the things I want to talk about, mostly because I don't think it's ever talked about enough, because I recognize that anytime I get in front of an audience and talk about bank capital standards, that makes most people's eyes want to glaze over, but it's an incredibly important issue. Why is it an incredibly important issue? Is that when the bank regulators decide to set different capital ratios for different types of loans, they are essentially setting the attractiveness and willingness of banks to hold those assets. For instance, I don't think you need to understand anything else to understand the European crisis than banks were required to hold zero capital against Greek debt. That's why they held so much of it. Whereas if they made a construction loan, they had 100% capital. We're starting to see the same direction in the United States, and a very big change that's being talked about is Basel I and Basel II, which were the previous rounds, only applied to large internationally active banks. So maybe 50 banks at most in the US out of 7,000 applied. There is a push today to apply these standards to all 7,000 plus banks in the United States. And so my concern is, and then again, I'll emphasize, this is a regulation and process. This is not a done deal. This is not an end game. But if it goes the direction it's going, you will see a very big change in the willingness of small, community, independent, regional banks to make real estate and construction loans, because the price of holding that capital for them will greatly go up relative to them holding treasuries or holding agencies. And it's going to be a very big shift. So I hope that this is I guess like I say as an aside, I spent 7 years in the banking committee in the Senate, warning about, in my opinion, a lot of things were happening, and I spent a lot of time wishing I was wrong, and unfortunately turned out right. This is an area I hope I am absolutely wrong that they fix ahead of time, but it is something to keep an eye on. If these Basel capital standards get in place, in my opinion, again, it will devastate the willingness of small banks to make these type of loans. Some other policy wildcards. It's, in my opinion, impossible to talk about commercial real estate without talking about tax code. Whether you get depreciation, how you treat interest. I certainly don't have a crystal ball in terms of what's going to happen in Congress next year, but one of the things that's potentially on the table, regardless of who wins the election, regardless of who's sitting in Congress, is corporate tax reform is potentially a very big issue. And to the extent that people push for simplification, which is certainly one of the things we repeatedly hear, you could certainly see changes in how interest is treated and how depreciation is treated. You can see some very big changes on what I think is a tax code that is generally fairly favorable to real estate. A lot of that can go away. And of course, that would negatively impact both the financing and property values. I mentioned the trend in retail toward internet sales. Certainly one of the debates we're hearing, and one of the interesting things is the tight budget situation at the state level has caused a lot of Republican governors who only a few years ago opposed any collection of internet state sales tax to suddenly be in favor of it so that they can close some of their budget gaps. You've also seen that sort of shift. I think it's fair to say, without going into too much detail on our fiscal situation, there will be a continued push for new sources of revenue both at the federal and state level. So again, not saying that an internet sales tax is going to happen uniformly across the country, but there's a very big push for that. I will emphasize, I do not think that that changes the trajectory of online sales, but I do think it changes the level of increase. And again, if that's what happens, one of the winners, of course, could be the brick and mortar retailers, and that will actually help bring back some of the retail market again. Another big thing, one of the things I've certainly spent last decade working on is mortgage finance reform, particularly as it applies to Freddie and Fannie. Freddie and Fannie have long been very big players in the apartment market. How this actually plays out and whether they maintain very big players in the apartment market, I think is anybody's guess, but this is certainly something that very big chance that the next Congress is going to try to tackle. And I will say, from having worked in those committees and worked in that environment, the multifamily will be an afterthought. Congress will not give some thought about how do we make sure that we preserve a Freddie and Fannie role for multifamily. I think it's fair to say the typical congressman probably doesn't even know that Freddie and Fannie are involved in multifamily. So again, that's something that I think is a wild card that can put a lot of damper on where ultimately multifamily financing comes from. And ultimately, you don't need to pick up the newspaper if you don't hear every day about the fiscal cliff that is impending of whether Congress extends the so-called Bush tax cuts and whether we have the sequester that it happens mostly to defense and other spending. But these long-term budget impacts are going to be a very big driver. And they're going to be a very big driver because once interest rates start to go up, if we don't get our fiscal house in order, and I certainly don't want to seem political and partisan, but I think as an economist, if we don't get our fiscal house in order, interest rates are going up long-term trend. And what that means is anything, commercial real estate and otherwise, is going to take a hit because of that. And certainly if we start to see questioning of the Treasury, I'm not going to quite say that we are in the situation of Greece, but if we ever were, 2008 will look fun. We'll look fondly back on that compared to, we'll finally look back compared to a world where treasuries start to be questioned. And so just to leave you a couple of conclusions before, because I like to think I've left you with a few at least controversial things for people to either agree with, disagree with, ask a little more detail. In my opinion, the commercial real estate market has largely hit bottom. I will emphasize I do not believe it's going to be a quick climb up. I think it's going to be a slow climb up, but I think the worst is behind us in that. And so it's headed in the right direction. Retail continues to be the weakest part of that, with multifamily and office being the largest part. Again, I will emphasize, as I started out, the speculative components of commercial real estate, or the more speculative components, have been the parts that have come back, whereas those that follow demand still drag. And again, in terms of office, in terms of manufacturing, the labor market's going to be the big driver here. And again, we still have a very weak labor market. Credit conditions, in my opinion, will remain tight for a very long time. And I guess I should emphasize, there really is a very big difference in this economy. If you can get credit, it's quite cheap. The question is whether you can get it. So I should very emphasize it's the issue of availability and not pricing. But again, I think in this environment, you're also starting to see banks being very reluctant to take anything that's got a long maturity onto their balance sheet. Now, in some sense, I think that's a good thing. We might go back and remember the S&L crisis, which in my opinion was mostly caused by you had 5% 30-rate mortgages on your books, and when federal funds rates started hitting double digits, you as S&Ls were losing money left and right. Banks have learned that lesson. They don't want to put themselves back in that situation. So again, unless they can sell it off to somebody else, unless they can securitize it, or unless they can hedge an interest rate risk, most banks today are very reluctant to take long-term loans onto their books. And again, I can't necessarily say I blame them, because I do think at some point over the life of those loans, interest rates are going up. So that's a lot. I'll also say, as an aside, as was mentioned, I spent 7 years in the banking committee, work in Washington, comment a lot on policy issues and politics in general. So I will say I'm not going to limit questions to the presentation, but happy to talk about anything under the sun. Thank you.
Questions for Mark? Well, I know some of you make products that go into commercial buildings. Question?
I think that there is, particularly with some of the older buildings, because I think, for instance, you've got that opportunity in a way where you're not as dependent on the financing. I mean, you obviously still need financing, but the rehab tends to be less of a duration. So the risk from the lender's side, interest rate risk, is a lot more minimized. So I certainly think it's going to be easier if it's the right property and the right plan to get financing than it would be otherwise.
Nobody's used the word green or energy efficiency in any of these conversations. Does that no longer apply to what's going to happen in the market, or is it just a luxury that's not available in these markets now?
I don't think it's going to go away. I mean, certainly there will continue to be a federal push, and I certainly would say that this is one of those things in which does depend on the election to some degree. Although, certainly for some trophy properties, for some markets, it's going to continue to make sense. But I think for the most part, I'll start with this story. I remember when I first was out of grad school and I worked at the National Association of Home Builders, and we would regularly do surveys. And I was always shocked about you would put these options to new home buyers, and people would have to have incredibly high discount rates. You could say if you spend $1,000, you could make it back in 2 years, and many people would just say no. They wouldn't put that out at the table. So what I would say is you're unlikely to see at the federal level as generous subsidies going forward. I do want to emphasize, and sort of started this out because I think it applies to the last session as well, we don't have a national market for these things. We have local markets. You often have local subsidies. You often have local building codes. So I would say I do not believe, for instance, the trend for localities to push to continue to have buildings to be ever more green, that's only going to continue. So I don't see that reversing. So I would say, in my opinion, the mandates will get harder. The subsidies will get less. And of course, the question is whether there's the ultimate customer demand for it. And I think the ultimate customer demand for it will increase. I just don't think tremendously. I think there's got to be, you have to show people that it's got a return on it in a short amount of time. And I think that will continue to be the case.
Another question? Yes, sir.
In your multifamily definition, do you have apartments in there as well as condos, or what's the makeup of multifamily for you?
The makeup for multifamily I've been using is any new property with 5 or more units, and that's the case whether it's ultimately for homeownership condo or for rental.
Yes.
Here you go. You talked a little bit about the size of the market for commercial real estate, and I am assuming that this reflects new construction. Do you have a feel for what percentage basis you would add to that for remodeling, and if that's shifted?
Let me say, yes, the numbers I presented are for new construction. I think I don't have the numbers in front of me for remodeling. It tends to be, if I'm remembering, maybe about a fourth to a third of the same amount. And I do think you're going to see some, again, because financing is easier on that side. So certainly I think in the interim, you can see more of that become remodeling than new construction.
One more question. Time for one more question. They'll just give me longer to talk.
There you go.
Yeah. Mark, thank you very,
Well, thank
very
you.
much.
Appreciate it.